Everybody got the emails? We like to give away cash because our job is to make you money in the markets. And a few people said they didn't get it. I didn't give Ed an opportunity. Sergio was out of town. Robert Jones, or Bob Jones from CliffordSales.net. Are you in here?
He's not here, I'll take it.
He's not accepting on behalf of, well, going once, Bob. Going twice, Bob. Bob, you just lost $100. We've done this before, we've gone down to 15, so don't go back. Anybody here from Polk?
Oh, there is a guy here from Balser. He's not listening yet.
Tom,
Yes.
come on down, my brother.
Go get it, Tom. Well, you're from the same company anyways.
Tom had a guess, $17,999. Market was $18,058. It's Mike.
Yeah. Tom's my first name, Mike's my middle name.
No.
These freaking guys from Wycliffe. It's on the other side of
It's the
town.
same company.
Same company.
We'll do that. Vote.
We don't, hey,
Now,
we don't tell Tom. We don't tell Tom that. I'll get the first round.
This is actually what I'm saying. Fuck your hand out. Now, wait, how do you make the guess? You gotta say wild ass guess or something. Come on, we gotta use something.
It was a wild ass.
Hit him in the back. All right, where we go? 20, 40, 60, 80. My commission.
All right.
There. You should. Thanks, Mike. We'd like to do that just to give you.
What was the number? 32.
No, we got it on the video. Got no video. Not a problem. That was an interruption for a commercial there. What we try to do, and the reason I do that is not to give away $100, but even though we like giving away money, what we want to do is give you a flavor for how difficult it is to predict and to guess the market. Because the majority of people that you watch on CNBC, majority of the people that are on Bloomberg television, they're very pretty faces, but let's be honest, they have no freaking clue what's going on in the marketplace. They have no idea. They're reading the script. What we're going to talk about today, though, is called game changer investing, and it's how to grab the bull by the horns. What you are going to learn in this presentation is 3 different areas. Number 1, why traditional asset allocation fails. That's the pie charts. Everybody's seen the pie charts that are out there. I'm going to teach you and explain to you, and you will learn why those things do not work and why they're not good for your health financially. Second one is I'm going to then teach you how to grab the bull by the horns. And finally, the best part that I enjoy, the part that I think the majority of folks come in here enjoy is the buy, sell, and hold. When you have your stock symbols, we will put them up on the screen, and I will actually analyze them on the screen, and I have no idea and I have no clue what you're going to call out. There is one genuine parts that a person asked me to bring up earlier, so I will start with that, and then whatever you throw out, pop them to me as quick as you can, just like a trader on the board, and we'll zip through as many of these as we possibly can. Hopefully we hit every single one you want. Why traditional asset allocation fails. Anybody seen a pie chart like this? Yeah? Basically, any brokerage firm that you go to, from Bank of America, Merrill Lynch, to Solomon Smith Barney, to good old D.L. Hutton, to any financial planner that's out there, what they do is they sit down with you. What do you see, Greg? I haven't seen you in a year.
I know.
What was that subway card you said about? Good?
Very nice.
All right, I like that. But basically what they do is they sit down and you fill out this chart. And you go through a questionnaire and they say, well, how do you feel about this? How do you feel about that? Can you lose 20%? Can you gain 20%? Basically what they're trying to do is go through this algorithm idea and this thought process and pigeonhole you anywhere from 0 to 1 or from 0 to 10 on a risk schedule. And then they plug you in. Every single time that you look, and this is a 60-40, this is basically a moderate portfolio. I went onto the web before I came in here and I was putting together this presentation, and I Googled asset allocation, and there were over 4 million hits on asset allocation. And if you are using an investment advisor today that is using this kind of an idea, fire them immediately. And the reason is because you're paying the guy for something you can get for free. There's a company out there everybody's heard of called Vanguard. Vanguard is now doing traditional asset allocation for guess what? The amounts. Any ideas? What they're charging? Zero. It's free. You have $25,000, they'll do it for free. And the other kicker that they just came out with about a month and a half ago was if for 2 quarters they underperformed the benchmark that you've chosen, which is usually the Dow Jones Industrial Average, they will rebate your fees back for the past 2 quarters. How the hell are you going to make any money? How are you doing things that are best for the client? What this traditional asset allocation is, when you sit down with a guy, they're going to put it 60% in the growth investments, 40% in the safe investments. The growth investments are mainly going to be in large cap stocks such as IBM, Microsoft, dividend paying stocks. Second portion is going to be in mid cap stocks, probably a smaller amount. Then an even smaller amount is going to be in small cap stocks, and possibly a smaller amount in international or emerging markets. Some folks have put in commodities and gold. On the safe side, as they call it, they're in long-term bonds, short-term bonds, you're in medium-term bonds, and you are in cash. Almost every single brokerage firm that you go to has this. Every single brokerage firm that you go to has this type of an idea. It doesn't work. Does not work. The reason being, if you really know what you're doing and you're a pro and an expert in this investment world, first thing is, in the past 15 years, small caps have been the best performer. Why wouldn't you have the majority of your money in small caps if they're the best performer? Large cap stocks basically have lagged for the most part of the past 15 years. But yet, these traditional asset allocation portfolios have the majority of your money in large cap stocks. And the best performer is getting anywhere 4 to 5%. Some of them, if you're very aggressive, will jump it up to 15% in small cap stocks. Doesn't work very well. Why would you bet on the best horse? You're betting on the nag in this case, and you're not going to win. The S&P, which is basically large cap stocks. From 2000 through 2012, guess what it returned? It's up on the screen. This is interactive, guys. Zero. Returned nothing. Basically, it went from here to here. Zero. Nothing. Not very good. 2008 meltdown was 60-40, where they will sit back and tell you, you need to have a little bit in bonds, because bonds and stocks don't both go down at the same time. Well, we're down over 23%. That's a pretty big loss. You're going to make 46% just to get back to even. How does that make anybody feel? How's your portfolio feel? Now, yes, the S&P was down better than 40%. Well, let's look at the safe side of the investments. Got Linus and Charlie Brown. Anybody know where interest rates are today? Any ideas?
What, long
Basic-
term?
Long-term interest rates.
0?
Extremely low. You hit the nail on the head. Pretty close to zero on a short term. If you have any money markets or checking accounts, which way do you think interest rates are possibly going to go? Up or down? Probably up, right? But negative. They could go negative. Well, the news that just came out this morning, we're not seeing inflation actually moving up. They just made the announcement this morning, and the March inflation numbers were actually 0 to 0.1, and that was negative. So that's not a good thing that's out there. We'll get into different portions. But as bond yields or bond interest rates go up, value of bonds go down. And guess what these traditional asset allocation guys are telling you to do? 40% of your portfolio there. Does that make sense? Now, what people then say is, well, Roger, I need a safe place to go. Well, it didn't help you in 2008. Did not help you in 2008. If you're taking a little flow chart and you're going through and you're saying, okay, I'm going to answer these questions and I'm going to pigeonhole you, please do yourself a favor, do not do that. Go to a company called Wealthfront. They're going to charge you 0.25% to do the same thing if you have $25,000 or more. You're getting asset allocation for free, and with Vanguard also. I'm not a believer in that idea and that process, because if you're a 50-year-old person, guess what? You need to have your foot on the pedal. because you're gonna need that money in anywhere from 10 to 15 years. So you need to have your foot on the gas. But people are sitting back saying, but isn't that risky? There's risk everywhere. As we just showed in 2008, with the bond market actually going down, bonds are risky investments. They've become more risky in the past 4 to 5 years since interest rates have gone to zero. What people will tell you, though, is bond prices have done fantastic in the past 30 years. Back to the old Linus and Charlie Brown, what happened? Bond prices, or bond yields went down, bond prices went up. So we're getting back some principal and some interest. You're getting the capital gains kick. That's going to turn opposite on you here shortly. I do not know when it's going to happen. They're actually saying right now that possibly the Fed will make a move with interest rates up in September. No idea. Nobody knows. I'm not a predictor. I don't have any clue. I can tell you where we're sitting today. Bonds are staying pretty much low, but they're possibly going to start on a movement up.
Can I ask one question, sir?
Sure.
Back to the slide on that, you don't have to go back, but the asset allocation, I'll be the first one to admit, I do that.
Okay.
So, and I've asked my advisor for 7 to 8% return over my lifetime, and he's hitting that.
Okay.
Are you saying if I didn't do that, I'd be making more now?
What was that?
Would I be making more not doing the asset allocation?
Absolutely.
Okay.
Let me toss this up to, how old are you?
I am 47,
You're 47 years old. When do you plan on retiring?
48.
You know what? We need to talk. Sorry, guys, we're done. Let's go. I'm buying.
No, I want to get out in low 60s.
Yeah. All right. So basically, you've got 14 or 15-year time frame.
Sure.
So let me put it this way. You're saying 7 to 8%. Let's say the market does 14%. Are you happy?
I am. 7 or 8% is what I want. Is
Right,
what I,
but-
for my lifetime.
But is the market every single solitary year going to do 7 to 8%?
No.
Okay. Bernie Madoff will tell you it's going to do 8% per year. Bernie Madoff's now sitting in the
Right.
And by the way, I'm not Bernie Madoff. I don't play him on TV either. But what you're looking at is for somebody to sit down and give you these projections going out and say, we can do 7 to 8%.
Right.
As an advisor and as an investor myself,
Right.
when the market's going up, you're an aggressive investor.
Right.
No doubt in my mind. The market does 30. Are you happy with 7? Anybody? Hell no. Excuse my French. But no, you're not. But if the market's minus 30 and you're minus 20, are you happy? No. What you want to do is when the going is good, you have to grab it by the horns, lack of a better word. So as where we're talking about this investment idea, when you're doing the asset allocation at 47 years old, why are you owning bonds? Why? Why?
But what if I don't have a lot in bonds? What if my bonds are minimized and that asset allocation?
Why are you owning bonds?
Only if
Diversification.
only if the market's going down.
On diversification?
I said,
You said diversification. Bud, tell me why you want to diversify.
that's to minimize your risk,
Okay, let's go back to 2008.
okay?
Did that work?
Didn't work for me, no, but,
Did it work?
no, but that's the concept behind it, I believe, is that it will diversify.
Theories are great for academia. In real world,
Right.
doesn't work. If I'm just talking to you as we're talking here, basic bottom line, 47 years old, you have no business being anywhere but the U.S. stock market and possibly the international market, which we're going to get into.
That may not be international.
Here's one of the problems that we have as not being able to pay attention to it on a daily basis. Jim Cramer and CNBC and all these wackos out there, they're just locked in a box. They go like, you gotta diversify, you gotta sector allocate, you gotta your asset allocate. And you sit there and go, now what am I supposed to do? But I'm not getting it. And then go pick your stock that's gonna be a winner.
Raj, are you home? Yeah, I'm here. What do you need? What do you need, Christopher? Yeah. You're where? Oh, I'm with Sergio. I'm down in the Caribbean. We're having a couple of pina coladas. By the way, has anything happened? I just got an email this morning from a client in Cincinnati, Ohio. I manage his 401k, which we'll get into. He said, my 401k is making changes. Advise me. Joe, I'll be back to you this afternoon by 3 o'clock. He will have an answer by 3 o'clock. He will make a change tomorrow. Portfolio will change tomorrow. You know what he did? He wrote me an email and said, my 401k is changing. Help me. That's all you have to do. Because you're out doing what you do best, and that is selling and keeping your company going. You're helping me, giving me an opportunity to help you manage your portfolio. And as I will show you, I can almost stand here and guarantee you, the majority of folks in here, except the ones that I've been working with, aren't doing, they're doing the traditional asset allocation. And I think we've proven that it doesn't work. I can go deeper into this, but it doesn't work.
Absolutely,
And I think 2008 is what showed that. So to answer, it's Brad, right?
Brian?
Brian?
Yes.
You have no business owning anything with stocks. Period. Or,
Individual stocks or mutual funds?
we'll get into that. Keep that thought, okay? Go ahead, Rob.
Slide up there with, was I put on the gas pedal?
Mhm.
And you said now you're 50 years old, you want to have your foot on the gas pedal.
Absolutely.
You're 60.
Still do. I have 85-year-old clients that are 100% the market.
Yeah, but 100% in the market, but same kind of stocks that you have, they less aggressive.
When you say aggressive, see, when people are out there, they put, as you mentioned, Christopher, they lock you in a box, and it's all based on this modern portfolio theory that goes all the way back, that was written back from 1929 all the way through. I don't know anybody here who's going to be invested from 1929 through 2015. There's nobody, my son who's 13 probably can't even do that. So what they do is they put you in these little boxes, they say conservative, aggressive, moderate. I don't use those boxes. Because when the market's going up, are you aggressive? You want to get where the market's going, right? The market's going down, you're what? You're conservative, right? Everybody is. So all that BS that they throw out there, it's not true. It doesn't work. It's a marketing ploy by the major brokerage firms. And they have got so much cash that they throw it out. 90% of your advisors that are out there, 90% of them have no clue what they're doing.
Is it costing us more though? Because, I mean, this, it really interests me because I am in an asset allocation. What they told me it costs less as far as fees, like you're gonna charge me for
Negative.
making those highs and low moves.
Absolutely not.
Okay.
Because what they do, and this is the other part that I don't have up here, what they do is they do rebalancing.
Of course.
Which, oh my God, that is a domino move, if that's a word. It's the dumbest move out there. Why would you take and cut Michael Jordan, who is the best player that's out there, or cut LeBron James, and you're going to all of a sudden put in, pick who you want, who just got knocked out of the league? Why? These guys sell the best and buy more of the worst. Does that make a lot of sense? I go to the Kentucky Derby almost every year, not this year because somebody who's around here is going, and hopefully they enjoy and put a bet in for us, but it's like going in and saying, I'm going to bet on the 60-1 odd, even though I just made money on the favorite last week. That makes sense. You put more money into the good and take away from the bad. If you guys have salespeople that work for you, and the guy's not selling anything, do you make his territory bigger? What do you do to the guy who's selling everything? This guy's pretty good. I'm going to keep this guy going. So does that make sense to you? And we kind of just knock this thing out of the ballpark, I hope. Because I really got it. What these guys do, and the question I always get is kind of where you're going, Brian, why is it still used? Number one, because it's easy to sell. It's a great story. Number two, I believe what they're telling you is we're just buying a whole bunch of lottery tickets and hoping and praying that one of them hits. It's like betting totally across the board on every single horse. Which you could do. You know what? You're going to say you're a winner, but you're also not going with Mike to go to the bar and buy. Does that make sense to everybody? Does everybody follow me on this?
What about the growth funds that they put out there for 2035, 2040? Is that all allocation?
That's all asset allocation. That's all they've done.
Okay.
And those things are actually costing you double fees because they're charging you the internal management fee. Then they're charging you to put it together. They are called lifestyle funds. Worst thing ever invented. Anytime Wall Street comes out with something and tells you it's good, guess what? It's not. They need to put a Surgeon General warning or whatever you want to. It's not good. Wall Street is there to do one thing and one thing only. Make money. Guess who it's not for?
Yeah.
Not the investors. Not the investors. Total different idea. how you grab the bull by the plate.
Then why shouldn't we play?
Why should you
Well,
play?
because we can make money. Sorry.
We're gonna get in
Sorry.
why you should play.
Sorry.
But the other problem that these guys have is they have one playbook. You know what their playbook is? Buy. Buy. It's on sale. That doesn't make a whole hell of a lot of sense to me. Why do you buy stock at 50 and it's a better deal at 30? If you're dollar cost averaging in, you're not gonna win the game. I'd rather dollar cost average on the way up than on the way down. So they only have one playbook. We have two playbooks. Playbook number one is when the market's on offense. Playbook number two is when the market's on defense. You ever watch a football game? Who usually wins? Team with the best defense? Team with the best offense? Because they play both, right? And you have a game plan. You walk into this game, Bill Belichick walks into the game, I've used the Browns coaches, we have no clue if they're gonna be there next week. But they have a game plan for the when I have the offense on the field, or when I have the defense on the field. Right now, we're in an offensive market. And I can show you another way when I get into the buy, sell, hold, I'll show you another idea. But the philosophy that we use is called point and figure charting. This slide may look familiar to those of you that were here last year. Point and figure charting, and this young chap right here, is Charles Dow. He was the first publisher of the Wall Street Journal. He created what's called the Dow Jones Industrial Average. Charles Dow was what is called a fundamentalist. You don't need to write this down. We got it all on tape. We'll give you the slides. Just
Now I remember that.
shoot me over. Okay, not a problem. If that, whatever works for you, just trying to save you time. Well, basically, what Charles Dow did way back in the late 1800s, early 1900s, he was basically a trader. And he would sit down and he would try to figure out which way the market's going and which way stocks are going. He did not have CNBC. He did not have the Wall Street Journal. What he did was he would write down the prices. And what Charles Dow believes is everything out there, no matter what happens, the market is based on price. So if I ask you, Anita, what makes the market go up and down? What's the answer? Price. Price. If you have more buyers and sellers, what happens to the price? It goes up. More sellers and buyers? Buying and selling are equal? Price stays the same. There's nothing else. There's nothing else. And we do not look at the reasons why, because you know what? I don't care. I don't care why the market's going up, which may sound strange to you. What I care about, though, is that it is going up. And take oil. Recently, what's happened to oil? Anybody have an idea?
It's going up now.
Why has oil gone down? This gave the answer.
Political.
Supply. More supply than there is demand, right? It's going to change. Some people say it's because George Bush is out of office. Other people say it's because Hillary Clinton's coming in office. Other people say it's because Ted Cruz is coming in. You know what? I don't care what they tell you on TV. I don't care what Jim Cramer tells you. Jim Cramer is very, very good theater. That's all he is. Follow his picks. And there's a couple websites that do. And then, after you lose 50 to 60%, call me, we'll try to recover, but it's going to take us time. But basically, Charles Dow actually sat down and started doing this figuring. Right there is exactly how the market works. Supply, demand. There's more supply than demand. What's it going to do again? Go down. This is the original chart that Charles Dow did. Original chart. What you see is this one's actually trending up. What would happen is if we go all the way to the left-hand side, stock would be 39, or 38. Start at 38. And what Charles Dow would do, I really got that in there twice, is he would sit down and he would try to figure out where the market's going, and he'd put prices in. But the last slide that I just had up there was kind of confusing for the majority of people, because what you didn't see is on that, how can you tell which way it's going if supply or demand is in control, really? You can't. So what they did in about 1936, 1937 area is, some very smart people said we're going to change this to where X's means that demand is in control and prices are rising. O's mean the supply is in control and prices are falling. There are specific rules, and if you get this part, guess what? You're an expert. This part is an expert. You alternate columns of X's and O's. The minimum of a 3-point reversal is what we call. So you've got to have a column of at least 3 X's or 3 O's. I'm gonna show you the flow chart on how you could do this. I actually chart anywhere from 300 to 400 stocks per day, and it takes me anywhere from 30 to 40 minutes to do that. And it's very quick, boom, boom, boom. Time is the action in the first month. You can see if something changes in August, September, A, B, and C are October, November, December. The only thing that we use are the highs and the lows for the day. All the other movements during the day are noise. They do not matter to us. Majority of my work is done in the evening. I can't tell you right now what the market's going today, and I really don't care. I'll tell you tonight what happens. I can tell you yesterday it was on the upside. This is the flow chart that I use. The charts in that is falling, and in a column of O's, I check the daily low. Did it fall? If it did, I put it in the appropriate box space. I will put another O in it, and then I go down and move on to the next chart. If it didn't fall, I say, did it reverse up on this chart? Once again, it's got to make a move of at least a point. Some of them we do at a half a point based upon the prices, so we can make sure we have some trending action. And if it did move, we then move over a column, change it, and put a box of X's in its place. That's how simple it is. That's how I'm able to chart these stocks in such a short period of time. They make specific patterns as we go through it. These are the first two basic patterns that you need to know. First one's called the double top. Double top is very positive. So if you have a stock that's on what's called a double top buy signal, one column of X's exceeds a previous column of X's. So if we take a look at this, the stock was at 39. We don't, once again, don't care about the time frame. The time frame does not matter. You can have a stock for 15, 20 years. It's on a little 8.5 by 11 piece of paper with all the movements of the stock. Basically from 39 to 31, the stock went down. All of a sudden, the stock made a movement up. 3-point reversal went up to 34. Not a buy signal yet. Because the only time you have a buy signal is when a column of X's exceeds a previous column of X's. Stock then pulls back to 31, which is support, goes back up to 35. At that point in time, that stock becomes a buy. Column of X's exceeding a previous column of X's is a double top, which is positive. There's a variation of other patterns that happen. What Charles Dow figured out way back in the late 1800s was these patterns, that they continue to repeat themselves. History does repeat. They do repeat themselves. The opposite side is a double bottom. We take a look at this. Stock's going from 30 up to 38. We're looking good. All of a sudden, stock gets some supply comes in, moves to 35, gives you a chance to move out. Then all of a sudden exceeds, goes to 34, becomes a sell signal. If you work with us, you'll hear these a lot. Double top buy, double top quadruple buy signal. There's a spread, there's a bullish percent, there's different things that we put in there. But if you get these two, you've got 99.9% of the advisors out there. Sir?
Let me ask you though, where did you buy in at this stock? Were you at 30 on the?
On this is just an example.
Well, I'm just trying to
So,
get a feel because,
Which one do you want me to do?
you know, if I bought in at 38 and then you
On this one?
up to 34 and you're selling.
On this one?
Yeah.
Okay, basically, you're saying we bought in at, where, 38?
Well, you're tracking it, okay? So
Yeah, we're tracking it. We don't have the rest of it there. But when we get into the buy-sell holds, you'll be able to see where we would purchase something.
So in a case like that, if I bought at 30,
You bought a third.
so
Right.
we're doing great all the way up to 38, then we dropped. Why didn't we sell it when it hit 35 there?
Because it's not a sell signal.
Right.
Because usually the first movement to a column of O's is false. And usually the first sell signal is false.
So that could have been like profit taking by the
Could be
market.
profit taking, could be a big position that comes in. As I mentioned earlier, we don't care about the why. What we care about is what's happening. This process is very unemotional. We don't get married to stocks. We don't get married to investments. We don't care whether it's in Euro, China, Indonesia, Thailand. I can basically analyze a stock anywhere in the world. It's traded over $5 a share.
If that stock there, okay, if we're trending it, we saw it drop down and it says, okay, this looks like a good play, get in at 35.
Yep.
You did create it at 38, but now you're saying
Well,
sell it.
hopefully, if we bought it here at 35, I end up selling it at 34.
Yeah.
Let's say this is the same stock, but different time frame that's happened. We sell it at 34. Possibility is it's probably going to continue down. There's a couple other additives that I haven't gone into. I mean, I could make this 8 hours of detailed, but basically, kind of, what I'm trying to do is get you to recognize the patterns.
Well, if you said, is it starting to trim back down again the second time?
Mhm.
Why would you bail out at 36 and be done with it?
Because it's not a sell signal.
Yeah, you have to.
I have to follow the specific rules on this. We don't try to forecast, and we don't try to guess where the market's going. We don't try to guess where the stock is
So
going.
when we're down to 34,
Went down to 34, it's the double bottom sell signal, we bail. Supply demand and control here.
I got a question, do you track this daily, or do you track this weekly, or?
Daily.
Yeah.
Daily.
So you can buy and sell stock 3 times a week? No, twice.
You, potentially you could, have I ever, no. I have stocks that, I have indexes that I've owned since March of 2009, and I'm still in. And I'll get into that and explain exactly how we do it. On this is the chart that you can see. Left-hand side, we've got the numbers. Down here is actually the time. This is 1 year, right here. So what you're seeing, this is called a resistance line. On the bottom, that's a resistance line. This is that's a support line. This is a bullish resistance line. Basically, what you're seeing is as long as it's above that area, it's positive. So to answer your question, in the back there, right behind you, Mark, let's say we had this stock, we bought it on the buy signal that happened right there at 49. We'd ride that stock up, all of a sudden we'd end up riding it up, it's gonna break, right here at 50, we'd have made a buck. Not a lot, but just giving you an example on how that works. These resistance lines are like brick walls. When they hit it, usually they bounce off, which when we do the buy, sell, hold, I'll show you some examples on that.
Then your double bottom is
At 53 here,
yeah,
on this, it didn't exceed the previous column. So with the numbers that you have in there, it has to exceed the previous column of O's, or it breaks the resistance line.
What establishes the resistance line?
45-degree angle.
Purely.
45-degree angle. This stuff is so simplistic. I'm an ex-football player. It works. It's simplistic. Yes. No, really,
Is
I'm
that a universal number? I mean,
It's a
for everybody,
45-degree angle, right across the
everybody in
board.
the world uses it.
Everybody in the world that uses one-figure charting. There's candlestick charting, there's Gann charts, da-da-da. This, I actually started doing this 1996, 1997 area, and it saved my career. Because I was crashing and burning every single solitary time the market changed. And I was trading a lot that didn't benefit my clients. I discovered this and took off. Question I'm asked a lot is, what's the market doing, or what's the S&P doing? Anybody here last year? Yeah? What did I ask you to do last year? To go back and ask your advisor one question. Does anybody remember?
Yeah, which S&P does it?
Which S&P? Do you know there are 2 S&Ps out there? Did anybody do that? I know one person did, but they're not in here right now. Go back and ask your advisor, do you guys know there are 2 S&P 500s?
No.
2 S&P 500s on the exact same stocks. Exact same 500 stocks. Yet act differently, trade differently, and perform differently. First one is called the U.S. House of Representatives. That is what's called cap weighting. Anybody here from California? California, how many representatives you guys have? Way too many, right? Way too many. Anybody here from Rhode Island or Wyoming? Rhode Island and Wyoming don't have a very big representation. When you hear on CNBC and on Bloomberg and in the Wall Street Journal, they say the S&P 500 did this, performed X, was up, down. What you're actually seeing in that is they're talking about the cap-weighted portfolio. What that is on this California with more representation than Wyoming. With the 2 S&Ps, what you're seeing is Apple is the #1 stock in the S&P 500, which on the cap-weighted index, if it moves, it takes 3.02% of the index. If you look down at Teradyne, it's 0.02% of the index. It says cap weighted. The other one is called an equal weighted index. The equal weighted index is like the Senate. Each state gets 2 senators. Whether you like them or not, they each get 2 senators. By knowing which one of these indexes to own would make a dramatic effect on your portfolio. Dramatic effect. The problem is, these guys that are using these pie charts don't do this. I'm going to give you a philosophy right here that every person should have in their portfolio, and if you don't use it, shame on you. And I'm very bold about that. How we get there is called relative strength. Relative strength basically is a ranking system. What relative strength does is it compares one thing to another. What we do is we take the price of one stock, say the stock price divided by any index you want, multiply times 100 to give us a better opportunity, makes the number bigger in order to plot. Put on a point figure chart, tells us whether it's outperforming the index or not. We wrote an article for Manon, if any of you get the agency sales magazine, we wrote an article called Pound for Pound. Read that article, it may give you somewhat of an idea, because people try to figure out with the NFL draft coming up, who's the best player. And it's comparing one thing to another. They did the NFL Combine, they're comparing one player to another. We do that with stocks. And it then gives us a ranking. You've got the world golf rankings, you've got the tennis rankings, you've got the FIFA rankings. We used to have rankings for football, but they blew away that since Ohio State won.
OH.
Iowa. Well, by knowing which one of the S&Ps to own, going back to 1999 through 15, on a 16-year basis, hey, Brian, you're going to retire, what, about 15, 16 years?
Yes, sir.
Seconds.
There's your difference. Which one would you want?
I think I'd like to have the top one.
You'd probably rather have the top one, right? In your traditional asset allocation, are you getting this?
No.
How's
You
that
guarantee me
7%?
that?
How's that
I will
7%
wire you
looking?
money today.
I can't guarantee anything.
All right.
I guarantee you one thing, I'm going on a plane on Saturday, hopefully. But those are the two, to give you somewhat of a difference, these are the two S&P, exact same stocks.
Yeah.
Just the difference of the weightings. Yes, sir.
How do you know which S&P they're reporting on the news and that sort of stuff? I mean,
Because the reporting, they don't report on the capital, or the equal weighted index, they don't report on the cap weighted. Pretty alarming that they're not talking about this stuff. That's what's scary. They're not giving the public what they need, in my humble opinion. So what we're going to do is we're going to repackage the S&P 500, and I'm actually going to take this back further to 1991. And these are the symbols. RSP is the equal weighted index. SPY is the cap weighted index. That's a relative strength chart on your left that's up there. The one in red means that we should have owned the SPY. The one in the purple means we should have owned the RSP. And as you can see, from 2000 to 2008, you would have basically been down 0.79. Can't guarantee it's going to go up. But you can see the performance is a little better. Then from 08 to 09, we went into the cap-weighted index, did not perform better. Basically, that market was flat. We did not have a trend. We need to have a trend for this to work. That's one problem with point-and-figure charting. If the market is in a range, it's not going to work. You're going to be treading water. Buy and hold, during that period of time, you'd have been out buying and holding the equal weighted or cap-weighted index, you'd get 442%. Keep in mind, we've had the rollings in the markets. Second part is buying and holding of the RSP, which is the equal weighted index, you'd be up 768. Knowing how to switch the two, 100% more in your portfolio. 100%. If you follow what I write, and on the 2-Minute Tuesdays that I do, we usually tell you which one you should be in. Costs you nothing, except a few minutes, 3, 4, 5 minutes. I call it 2-Minute Tuesday, but I happen to ramble when I get on there sometimes. This is called the People's Portfolio. What we've done is taken the S&P 500s, the two S&P 500s, compared them, then threw in money markets. I have 3 working parts. That's it. But guess how many stocks I own? 500. So there's your diversification. So I have 500 different stocks that I own, and I've got the diversification. What we've done there is done the relative strength calculation, to say, should we be equal weighted, cap weighted, or should we be in cash? Sir?
How do you decide how much of each of those 500 stocks though? Why don't you,
They're cap weighted. On the equal weighted index, that's already done by the index.
are you talking on the index itself?
It's just on the index themselves. So if you take a look at this, and I took it back to 1991 again, money market would have returned you 90.62. The S&P, which is the House of Representatives, which is the which one? Cap weighted, would have performed 442, S&P Senate 768. By switching 860, and by putting in the money market account, you're now up 1,170%. It's called the People's Portfolio. It's very simple. 3 moving parts. 3 moving parts. 2008, the People's Portfolio moved you out of equities in January. You were sitting in a money market account the majority of the time of 2008. It's not because we're geniuses. It's not because we knew the market crash was coming. It's an unemotional calculation, and the portfolio showed that on the relative strength we moved over. Does all that make sense to everybody? Are you getting something from this? Yeah. So what we do with the relative strength is we then, and this is for individual portfolios that we manage, we take 6 different asset classes. U.S. stocks, international securities, commodities, which we're not going to have pork bellies put on your front door stuff, because when you say commodities, don't think that we're actually buying the commodity, we're buying the index. Okay, so it's pretty safe with what we're doing. And you have fixed income investments, and then you have currencies. We have those relatives through the relative strength. Think of a relative strength as we took every single person in here, we put 2 rows, a row of tables up right here in the middle. Each person got on the side, and we did an arm wrestling match. And so each individual person had gone against each other that day. We would then go down the list and say, okay, Brian, you had 42 wins. Sorry, Craig, you had 13 wins. You're a little further down. So we do that, and we rank it in a matrix. So we rank them from top to bottom. We wrote an article that was in, what's it been in, 4 or 5 different magazines about the NCAAs. Who usually wins the NCAA tournament? A number 16 seed or a number 1 seed? Usually, if you're betting on a number 1 seed, you're probably going to be in the money. Not saying you're going to be in the number 1 spot, but you're probably going to be in the money. And it's usually the little old lady that sits in, I'm sorry, it's a little old lady that sits in the front and goes, favorites, 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 favorites. Oh my God, I won! Then you have guys like me that are sitting there trying to figure out which 15 seed is going to beat the number 2 seed and which 12 is going to beat the 5. And the first day my bracket's gone. So do it on the seeding. That's what we do. We call it Dolly. This is the Dolly, the guidance that Dolly gave us. We buy the top 2 asset classes. That's what we buy, the top 2 asset classes. In January of 2008, we were in money market and commodities. Foreign currencies came in March. We had foreign currencies and commodities. Commodities got kicked out in July, went to money market, kept foreign currencies. On October 1st, we were sitting in money market. How many folks would have been very happy sitting in the money market account October 22nd of 2008? My clients were sitting in a money market account. I looked like a fool, believe it or not, in late July, early August. I had clients call me and go, what are you doing? Market's going up. We've got to follow the indicators. We have a saying, when the charts change, we change. Charts don't change, I don't change. Every single time that I've had a problem is when I don't follow my rules, and I think I'm smarter than the process. We didn't get back into the market until January of 2009, when the international equities, they got kicked out. 12 days later, so we do have times, Wayne, where you would ask. We can't monkey around with that. It happens, boom, we move. That's the key part. And then we actually got back in January or September of 2009, international equities and domestic equities. Domestic equities have been the number 1 asset class ever since March of 2009, when the bull market actually started. That we are currently in. It just had its 6-year anniversary.
Is there fees associated with every time you make a move for all that stuff?
If you're losing on a monthly basis, maybe.
What I wanted to do is give you an example of what happened in 2008.
Yeah.
And based upon the portfolio that you're in and whoever you're working with through a brokerage firm, there can be fees, there cannot be fees. And when I say that, if you're working at, say, Vanguard, or let's say TD Ameritrade, you can have an all-encompassing fee. It's like, some places is 0.25, others are 0.35, it depends. But the trades that we make, historically, we don't make a lot of in and out trades. What I was trying to show you there in that slide is what would have happened in 2008. This gives you the highlights of our S&P 500. And basically what I want to show you in this is from 2003 through 2008, international equities were in position 1 or 2, 1,500 days, commodities were 1,000 days, and U.S. equities were 616. But here's when the international equities, they went in for a week and came out. What I'm trying to show you here is it can happen. And we do have movements, but what we're following is exactly what the market is telling us to do, what the charts are telling us to do. If anybody wants copies of this, again, shoot me an email, we can send it over. We'll have it up on YouTube in a video for you. Anybody have 401k? How you manage it?
I don't.
They don't give you the funds to manage it very well.
They don't give you the funds management very well? Why is that?
They don't want to.
Obviously, you're not owning the company, right? We can help you manage your 401k.
Wait,
It's like we're doing there.
you mean you manage the funds that are available for the 401k?
If you own the company, yes. But what we do is we take the menu of options that you have, and we will tell you exactly what you need to own, and I'm going to show you exactly how we do it. Exactly how we do it. Because what happens is, you go onto your 401k website, and what do? What's the first thing you see? What do you
Well,
have?
I use somebody like you for a safe harbor, so they just take care of it.
Okay.
So I don't even have
What's
to
the
want it.
first thing you see? What's the first slide I showed?
Asset allocation.
They show you asset allocation, right? See this pie chart?
Yes.
See this pie chart idea? And I'm going to show you an example of one from a client of mine that owned almost every single solitary fund. If you choose to do this, it's a free service for us to do. If you choose to continue with it, obviously, we're going to get your password. We're going to log in as you, and we're going to help you make the changes. And we're going to send you a bill every quarter, which we like you to pay it expediently. But what we do is we need a list of your menu options. What that is every single solitary option that's available in your portfolio. I need your current allocation. What we then do is we do a relative strength ranking, which is the matrix, where everybody fights against each other. Fights against, and then what we do is pop a new thing in here that we've started to do. It's called the cost of the problem. And what the cost of the problem basically is tells you whether or not what we are recommending in the past year would have been positive for you or negative. So I'm going to go through that and give you an example. This is actually the relative strength ranking that you see here. Green is good, red is bad. Kind of highlighted the top 5, because what we historically do is we buy the top 5 and put 20% in each. We will hold that, let's say you've got 20 funds, we will hold those top 5, and they're going to move from jockey for position, somewhat as a horse race. If all of a sudden one of the top 5 we own drops all the way down to number 10 or 11, we then have a decision to make. Should we sell it? Should we keep it? I usually recommend to sell it because it's dropped in ranking for a reason, and we then buy the next one that is sitting in the top 5 position that we don't own. Very simplistic. Green is good, red is bad. These, on white is actually where it's starting to make a change in a symbol move, and that tells me I've got to take a look at that individual relative strength chart. What you see on this is you've got, up on the left-hand side, where we've got the Allianz Wellness Fund Class A, going against a money market account, it shows DX. It's on a buy signal, it's in a column of X's. Very positive. It's the best you can have. SO is on a sell signal in a column of O's, which is negative. You don't want to own those. When you see an O with a B, that's the second best position that you can have. But basically what is happening there is The security that you're owning is taking a breather. We don't know whether or not it's gonna go to a cell signal or not, but a lot of supplies come into the portfolio and into the relative strength ranking. So we rank those based upon the number of buys. A buy signal, as I mentioned, is gonna last anywhere from 18 to 24 months, sometimes last longer. You have a question, John? That's how you manage your portfolio, because guess what? You are in the best of the best. We're buying the All-Stars. We're buying the All-Stars. This is kind of hard to read, but I put at the bottom. What we did here, this is an example of a, once again, moderate client. Sir?
I'm sorry, is that getting monitored as it goes into a system, monitored daily? Or do you
Monitor
have
on a
someone-
daily basis.
Okay,
Those numbers are computerized and run on a daily basis. We used to do the relative strength numbers by hand, and we did it once a week on a Thursday. But with the computer power that we now have, it's done on a daily basis. And the calculation numbers, if you did that just on the Dow 30 stocks, you're doing 250,000 calculations, and they're done that quick. I can do a relative strength ranking on a mutual fund such as this of the 401k portfolio in a matter of 2.5 minutes. And that's from putting the funds in to getting it back, listing the rankings and showing you exactly there. So what you see on the previous slide is you will actually see this. If you work with us or if you want to review, see a little highlight, we'll send you out a YouTube video explaining you need to own these 5. Some of them, if you're on a few of them, we had one client that owned the Buffalo small cap fund. I said it's looking a little aggressive because we then delve into the fund because we're showing a column of O's. I said it's on a buy signal, but a column of O's, you're probably going to see some weakness. Be prepared for that. We don't know if it's going to continue or not. But this gets you away from the traditional asset allocation idea, and you're buying the best of the best. You've got the 5 best reps working for you. You don't have 20 of them working for you. You've got the 5 best. So what we do here is, you'll see this, we then go back and we say, we're going to go back to the most recent 4 quarters. And we're going to take your allocation, and where I mentioned earlier, if you look at this allocation, this guy has 4%, 7%, 5%, 1%, 2%, 3%, all the way down to where on Touchstone Total Return Fund, you had 2%. This guy owns every single solitary thing there almost, except what, 5 or 6 of them? He's diversified. He's diversified. Did pretty well. This is $1 million portfolio, made $53,000, almost 54. Bad. Not bad in past 4 quarters. But, and there's always a but, using our philosophy, he'd have been up $185,000 in the past year. What do you want to be? So what I call the cost of the problem of being where they are, this is his actual allocation. He was minus $18,000. Third quarter of 2014, we were up $6,000. His return was 5.4. Our return was 18.59 in the past year. Brian, kind of beat your 7%, doesn't it?
That does, sir. Yes.
$131,000 difference, investment return difference over 13%. I took out a maximum fee of 0.75% that we charge on managing individual 401ks. Return would have been 12.44 net versus where he's sitting at right now, 5.4. Does this make sense to anybody? Is it different than what you're doing? Yeah? Are all you guys just stunned? Yes. Well,
Never saw that kind of return before. And I don't have $1 million to put in, by the way.
right, well, I mean, and you know what? Obviously, I used $1 million for dramatic reasons, but take away 0. Take away 2 zeros.
Brian has $1 million to put in.
Sir.
Well, you're
So if you're-
retiring in 15 seconds, what are you talking about?
if you're making it sound so simple today, and I'm not sure what everybody else's 401ks are doing, you know, why aren't some of the other companies, you know, why aren't the folks that our companies are hiring to help manage our 401ks, why the hell aren't they getting it? Or do they not want to, you know, and they're just an 8 to 5 guy?
They're sitting there, Wayne, you stand up and say that.
I heard the idiot part, that's that 8 to 5 guy.
Basically, what happens is, those guys that are there are salesmen. They aren't pros.
So are we able to take, so let's say, Brian's company, and he's got
$1
an
million,
outside
man.
company that's monitoring, or that he works with to do their 401K. Can an individual just basically take, I'm not gonna use the company we're using today, and I'm gonna take what I have today and send it to you?
Here's the best part. You don't even have to do that.
I can just ask you to
You
do
don't even
that?
have to do that. You know what you do, Doc? You give me your menu of options, give me your allocation, I run the portfolio. You never have to move your money away from where it is custody now. You never have to move that.
Yeah, we're talking.
You don't have to move it. It stays there. All I'm doing is monitoring.
Yeah.
I'm your security service.
Okay.
I'm monitoring your house. From Cleveland, Ohio. I'm monitoring your house.
But if we're in a managed fund now, we pull it out of there, just set the money, and you handle all that.
You don't even have to send the money.
Just leave it there.
What you do is you give me your password. Well, first thing you do is you let me run the portfolio process, so I can see exactly what we need to do. You then sit back, take a couple days, make a decision, say, Roger, I'd like to hire you. I go, okay, and they go, well, how do we get started? We just did. I send you a little one-page contract over, put your scratch on it, you give me your login and your password, and I log in as you. And guess how you fire me? Thanks, Anita. You change your password, because I can't get in. Any transactions that happen, you get confirmation. I never touch your money. I do not custody your money. I cannot be Bernie Madoff. I don't own a brokerage firm. I don't custody the money. I don't touch the money. You don't even have to tell the other guys that you're working with that you're hiring. Because it's a contract between you and I. That's it. It's
What
you
about
and I.
some of the stuff that we're doing, like for us to do stocks on our own? I mean, if we're, like whether you have an E-Trade account or TD and their trade or stuff like
You
that.
have a login and password?
Yeah, same thing.
I log in, it's done. Password 123456. I go in, I do the trades, you get the confirmation. It's that simple.
And how do we pay you then? Here, send us.
Preferably cash. The way we get paid is one of three ways, and it's all based on an asset-based fee. So if your account goes up, I make more, you make more, which is the industry average. That's probably the only thing that I do that the rest of the industry does. So say you've got $10,000. We're charging 0.75%. This bit based out on a quarterly basis, that's 0.1875. Let's say we started today, July 1st comes. Your 10,000 is now 11,000. Take your $11,000 times 0.1875. I send you out a bill. You write me a check. We can go through PayPal if you would prefer. I don't do credit cards because that becomes horrendous trying to do. And it's very simple. You send me a check. I pull a copy of your statement off. I put it in your file because the SEC does come through and go through all my files. Copy of your check goes in there. The other check goes into the Balser Foundation Fund. And you say, Raj, I just made X. I love you.
Or you can just take it out of our account.
If it is sitting at a Fidelity or a TD Ameritrade, we can do that. And for specific, Vanguard doesn't really like us. Depends on which firm that you're working with. And, and it's also a one-on-one basis how we do that.
I think it's all, keep it simple for all of us, I think, well, maybe I don't speak for all of us. I don't even want to see it.
Right, which is easy.
I don't want to write a check, I don't want to.
Which is easy, which depending upon what firm you're with,
Right.
and if they're large enough, there's actually an investment advisor. You make us your investment advisor, and we pop it.
Okay, I'm dumb, so let's just say I don't have one, and I got a bunch of cash sitting around, and I want to send you a check to take care of it. You have your own funds and.
We have a company called Pershing that we use,
Okay.
that we can run that through. One more question?
Yeah, I understand the 401Ks and all that, passport and all that, but if you're using like we use Northwest Mutual
Yep.
for our investments, so it's not a password. They control everything, they're doing anything, or at least that's
Right, they have a little spot where they're charging you a little over 1%.
too much, yeah. So,
They're charging you a little over 1%, you
Yeah.
call that guy, you fire him,
yeah, which is what I want to do.
and you fire him off of
Yes, but-
managing your account.
Yeah,
We then go in and manage your account.
Okay.
You can do it, you can make the trades, or we can make the trades.
Okay.
We go through this process, and honest to goodness, from the time I get your menu of plans, I do it immediately, do it that night, pop it out, do a YouTube video, it pops right over to you, you watch it, 9 out of 10 times I get a phone call the next day. What is all this stuff? I forgot. Because you are getting a lot of information. We then walk you right through it. You can make the change, I can make the change. I prefer to make the changes, because then I know what day they're done. Because I actually keep track on an Excel spreadsheet of every single transaction that we do, because I have to make sure I'm adding value to your account. Because if I'm not, you shouldn't have me there. You should not have me there. I'm gonna flip through to the next part. This is our playbook. Those are our 6 different, asset classes that we have. We actually drill down into this.
Yeah.
Drill down, we're equal weighted, small cap growth, and the concentration in healthcare, consumer cyclicals, industrial, and technology. So we can drill down as far as you wanna go with these. International equities is second, Asia Pacific, emerging markets, and Europe, developing. If you wanted to say, Raj, I'd like to buy stocks in Israel, we can do that for you too. We can pop that through. Our Dolly playbook is saying individual equity on level 1 is domestic equities, cap weighted, small cap. You invest in 2 different areas. First, trust focus 5, power share, small cap. This type of performance since May 6th of last year, you'd be up close to 17%. Not too shabby, considering the market's only up 12%. So we're earning our fee. I want to hit this part. Get your buy, sell, holds, your symbols ready, because we're going to pop into that. New things recently happened here. It's called Europe's quantitative easing. That's basically they're priming the pump. This gives you an example of the easing timeline that happened starting November 25th of 2008 in the U.S. S&P rallied 141%. Same thing is starting to happen now in Europe. They're priming the pump. If you're not in international equities, and a lot of the portfolios that we're managing, we're slowly going to start moving into that. Even the clients that I have that are here now don't own this yet. They don't know this yet. We've made a trend move. We're going to take a portion of the portfolio and start going into these different areas.
Isn't this gonna have an adverse effect on inflation, all the quantitative easing, I mean, printing money and pumping it into the markets, right? So now the
Yes.
the supply money supplies.
That's what they want. That's what Europe wants. Europe wants that to happen. On the why question, what did I say earlier?
You know, don't ask why, that's just, I don't understand.
I don't ask why. What they're basically trying to do is recover, and I mean, to explain, they're trying to recover their economies. And it's exactly what the U.S. has tried to do. Hasn't worked except in the stock market. It hasn't worked. So in Europe, you want to be international equities, emerging Asia Pacific, and developing Europe. I have specific models that I follow, that I use, that we will start putting everything into. And they're all based upon what? Trend. Supply, demand. We put them in a matrix. We put them in the matrix, we buy the best of the best. So if you want to be in Germany, guess what? We have a matrix for Germany, we buy the top 5. And the best part about it is how we manage these portfolios. I get an email that tells me, check out Anita's portfolio that is in the German model. We need to make a trade from A to B. And I automatically go in and make the trade from A to B. Anita gets a confirmation that it's happening. If you want a phone call, it's easy, but the majority of people would rather get an email because you guys are out doing your business. I'm not going to catch Sergio when he's down telling us he's working, he's sitting in the Caribbean. So let's go to the fun part. Buy, sell, or hold. Should I buy, should I sell, should I hold? We'll get out of it. Parts up. It's got a bearish price objective of 84. We then try to figure out where are we on this. We do objectives, risk reward, da-da-da-da-da. The downside, it's got a risk of 4.88%. There we go. But what you want to look at over here, and they've made the charts much easier, the X's with the green are buy signals. No, that's okay. We'd like to get this up. Uh-oh, now you're going to come up with how much money we have. seeing here, does anybody know stats 101? This is your standard deviation if you change it to the side, top, bottom, medium. Take a look at this stock. What did I say this was earlier? 45 degree, that's a resistance line. This is your resistance line on the bottom. Stock went to a sell signal, right here, double bottom sell signal, at approximate price of 91. Stock then pulled back up, gave you an opportunity to sell it, but it's under the resistance line, probably wouldn't own genuine parts. And I memorized it before I walked in here. Past year, this is down 12.4%, when the market is up 1. Not a good stock to hold. Somebody give me something you want on here.
Razor.
Give me a symbol.
ASR.
ADI.
And good old analog devices. On a buy signal, 1, 2, 3, 4, 5, 6 buy signals. Very positive stock. Actually broke through on the upside. Keep your trend going through here. Probably would have sold it back in August. Would have turned around, bought it back at 53. That does happen. Broke through the resistance. Sold, bought back at 53, ran it up to 64. Getting kind of near the top of the trading band. What you may see is it'll pull back because it's probably 2 standard deviations further than what it should be. It's got a little overbought on that. You're going to probably see the stock come back, but I would probably hold the stock right now. Continue to hold it until you're breaking the resistance line. If you are a trader, you're selling out at 56, which is a double bottom.
Try DYAX.
UIAX.
DY, DIAX.
DYAX.
Yep.
Got it. Wish there was an easier way I could do this, guy, but this works the easiest for us. You're the best. Woo!
You like this one?
Woo! Well, what you got is you got quadruple buy signals. Stock is major trending up. Way overbought right now. You're probably going to see it pull back possibly. More than 18 column of X's. Very top heavy stock right now. We continue to hold it based upon where you purchased the stock.
Less than $2.
You friends with him, Brian? Yeah, we'll be friends with him pretty quick. And what I would say is that's a great trade for you.
Yeah, I still have it.
Hold it. Make sure you know when you want to get out. Make sure you know when you want to get out. Because usually when we see a column of X's going like this, straight up, usually what happens, it comes back down just as quick.
Yeah.
Make sure you've got a stop in there on the stock that you're comfortable with. You're probably going to see a pullback here. Most of the time, they're going to trade around the...
They just offered like 2, I'm not, million shares at about at $27 a share.
Okay.
So it was like at about 30 and change was the highest, and then it come down to about 28 after they sold the shares.
Okay.
And then it's trending back up, but I have an idea where I want to get rid of that.
If you have it, make sure it's in your mind to put a stop order in, so it automatically executes. Because if that thing starts on a migrant south, you're in a world of crap.
Yeah.
Sir?
What does the cell signal look like on that chart? What's it gonna look like? What are you gonna see on there?
Cell signal actually on this would be double bottom with 15 and a half. So you're giving up a whole lot. A stock like this, that's where when I looked at it, I did a woo like. That's a very top heavy stock.
32.
But where do you see that
32 is
trending?
probably
Where
where-
do you see that? You said be careful and start to see it trending down. When do you see
What
that?
I would do if I bought this stock at $2, and this is just my opinion, thing turns around, hits 26, I'm bailing.
Yeah.
When it hits that top.
I'm bailing. Because you know what? Money in my pocket's much more than wishing.
You said you own 500 stocks.
Well, if I own the S&P 500, I own 500
Right
stocks.
before you
Yeah.
said you, okay, how many do you monitor? How many
Close
stocks?
to 300. 300 different securities. And that's from, mutual funds, down the line. Brian?
Ask me about his other 5 stocks he owns.
I'm not going there.
I'm kidding. Can you look up a crazy one for me?
Sure.
You're gonna laugh at me? OCAT. Because I'm a gambler.
You always were.
That's all right.
Oh, not good.
Oh!
You want to analyze this?
Tell me about that.
You can analyze it, I'll tell you exactly where you are. What do we have right here? Right through this part, up to 1050, you got a trending stock. You're in the trading zone on that. All of a sudden, breaks out of the trading zone, right at about $10. 1, 2, 3 buy signals, pops up, what did it hit? Resistance line. What did I say the resistance line was? Brick wall. Hit the resistance line, pop down. First sell signal, second sell signal. Probably gonna get a third or fourth sell signal coming on that.
What symbol did you put in there?
OCAT.
Oh, I see, okay. Is it 10?
OCAT.
That wasn't one time.
What you making like a month trade instead of a?
Can't do it.
Oh, you can't, okay.
Can't do that.
All right, well, that would make it look.
Because what we don't do is I don't shrink the sizes on it when I bring a chart up, because if I do it on monthly trade, I'm on the.
Because that's a brand new stock on the NASDAQ.
Try
And it's-
RBC.
If you take a look at that, I would not own this stock.
Oh, absolutely not.
What, the
The
RMC?
upside.
RBC.
What?
They're a big
Get
player.
it out. Who's going with you guys went there? Come on now. Big of a white corporation. On a buy signal. 1, 2, 3, 4. 1, 2, 3, 4 buy signals. Possible coming up on a sell signal, but we're still above the trend lines. I would continue to hold it. You're above your resistance line. Breaks through the resistance line. I would probably be a seller based upon where you purchased it. Purchased it around where? Any idea?
Would you purchase it? 17.
Breaks through the resistance line, I'm bailing
That was a
at
long time ago.
71, and I'm banking profits. There's never anything wrong with banking profits. Please. I would probably sold a third, and still held on to my final third the way through. But that's one right there. Once again, where did I mention? It's usually trading right around your middle of your standard deviations right there. Take a bell chart on the side.
When you see a chart like this, it looks like a pretty stable stock, man. It's not high fluctuations, or it did bottom out though at 6.
Well, you've got, I mean, all the way over, going back in the years, all the way over, you know, it's trending up. You can trade these stocks, but that's why a lot of the times when I'm managing portfolios, unless it's a trader who really wants to go in and out, which they're paying a much higher fee because it takes a lot more of my time. But as long as you're above this trend line, you're fine. If you hit this trend line, what may happen is it'll hit and bounce back off. Next.
TASR.
TASR. That was Taser. You guys didn't get that joke. Come on! Let me move that up just a little bit more. First thing you notice, on a buy signal, correct? Sell signal would be right here, right? 21. Coming back to the top of the trading band, middle bottom. And run this all the way out where it breaks the resistance line. Talking 13.5, depends on where you bought it. That stock is actually right now on a buy signal. I would hold the stock right now, probably would not add to it. Unless we had a little bit of a pullback back to the trading band right around here, which would put it at 23 level. If you wanted to add to it, you could add to it at the 23 level. I would continue to hold the stock until it broke to a double bottom sell signal. In this case, let's say reverse columns, move back, I'd be at 21. IBM? Big blue! I get a little excited about this stuff. I wouldn't own it. Why wouldn't I own it? First and foremost reason. Under the trend line. So what's going to probably happen, you can see, it is on a buy signal. It's on a double top. There's your double top buy signals that you're seeing. It's probably going to hit here and bounce back down. Probably what's going to happen. Historically, is what happens. See all up here how that happens? Hit, bounce back down, hit, bounce back down, hit, bounce back down. All of a sudden, man, we've got, starting in August, all the way down the column above it. Would not own IBM right now. But JP Morgan on a long-term buy signal. trading well above the trend line, as you see going across here, trading closer to the top of the trading band. 1, 2, 3, 4. 4 buy signals, 2 sell signals. These basically become meaningless because we're well above 45-degree resistance line. We continue to hold the stock. Would be a seller who breaks through the resistance line. Probably would sell third to half of the portfolio at 57 of the stock. You're going to break through the resistance line. You hit resistance line area at 57. Probably going to migrate on the downside. Because once it breaks through that resistance line, again, resistance lines are like brick walls. They're like brick walls. May hit that and bounce back off, but depending on where I bought it, I'm going to take some profits off the table. Again, always nice to put money in your pocket.
TEX.
TPI,
TEX.
TPX.
No, TEX. Terex.
Got it. So, why is it a sell signal? Sell signal actually happened up here. Quadruple bottom signal, 1, 2, 3, 4. Quadruple bottom signal at 33. Probably wouldn't have sold it there. Would have probably sold up here when we broke through the resistance line at 35, 36 area. Trading well below the trend line. Has started to make some movement up. Probably going to see it get up around this area, 31. We're down on the stock.
About GoDaddy. GDDY.
GBDY?
GDDY.
GBDY. I actually just like their advertisements. Buy signal. Want a buy signal. Not really enough to give a interpretation of it going through. Next.
How about a CERN?
CERN. Trading well above the trend line. A lot of X's, a lot of buy signals going through. Trading right near the middle of the trading band. Possibly could come down to a double bottom sell signal at the 69 area. If that happens, I would probably continue to hold the stock because it's just taking a breather. It's kind of like the Boston Marathon that they just ran. Majority of people are not Ethiopian and aren't running their 3-4 minute miles. Majority of people are going to run 7-minute mile, 8-minute mile, 12-minute mile. They're running a 12-minute mile right now with this stock.
ATO.
Trading on a buy signal, double top buy signal, had a double bottom sell signal, brought it back to the middle of the trading band, turned right around. Demand came back in control, trading above the trend line, would continue to hold it. And probably would look at selling it if it hit the 52 area. If we had a reversal on this, hits the 52 area, breaks through. Not just hits, breaks through. I'd be selling the stock at 52 right now to hold.
BABA?
Give me that one?
BABA?
And then we'll come back to the next one on the other side. We can go through it, but guess what? China is not the place to be, folks. Indonesia is the place to be. On a sell signal, trading below the trend line, right in the median of the trading band. Stock did hit a buy signal, but then reversed. Probably going to continue on the downtrend. We're not on the stock. If you own it, sell it.
Was that peak for them when they did their public offering?
That was the initial offering.
Is that what it was?
I think it was the IPO.
It was, yep.
But again, I mean, we're just
You
looking
don't
at
care, right?
You notice how you look at these things, and I don't even know half of the companies that you're popping out. You know more about them than I do. But what you're seeing is, by using this philosophy, it is so simplistic that it does not matter where in God's creation you want me to trade a stock. I can tell you whether it's on buy, sell, or hold. And we go back to the beginning, that's all based on more buyers and sellers. Price stays, price goes up. More sellers and buyers, price goes down, buying and selling are equal. Somebody else had one over here real quick, then I'll come back.
I just want to ask a question.
Oh,
Do you recommend stocks, or you just work with the portfolio we have?
I will go through, first thing I'll do is I'll go through your portfolio, and then I will put it through my cost of the problem, and show you by using the indexes and probably drilling your portfolio. 80% of the price movement of any stock is based upon being in the market, in the right sector. 20% is stock specific. I learned a long time ago with a company called Enron that you do not know stock specific. If you have one you want to look at, yes, you have what I call your mad money. Sure, we'll go into that.
Do you go into mutual funds?
I use indexes. I use what are called iShares. They're indexes.
Okay.
Because the problem when you have a mutual fund is you actually have a money manager trying to guess the market again.
Okay.
And all his job is to outperform a benchmark. Say the benchmark's down 25%, he's down 20, he still gets a huge bonus of your money.
Okay.
We're down 20%, the market's down 20, I'll fire him. Sir,
SWIR.
trading well above the trend line. Problem is the stocks come down, not on a buy signal, have double bottom sell signal. We don't count these down here because the sell signal happens here. Actually made a reverse, went to the middle of the trading band. If you own the stock right now, I would hold it. Preferably if we had been working together, depending on where you had it, we may have bought some puts up here or sold some calls to get some income on the insurance. Or possibly, depending upon the electrical system of the client, we just sold out a quarter to half of the portfolio at 41 and booked some profits. Yes, Rob?
Can you do Canadian, TD?
I'd have to pop it over to a different portfolio, but come see me afterwards and we can pop it over.
RY, is that Jamaican as well? RY's
Royal Bank of Canada on buy signal. Guess what it just did? This is perfect for banks on this plan. Guess what it just did? So what would you do? You got it. It's trading above the trend line, just broke through the trend line at 65. That stock is a buy. Made a lot of movement. This is a diamond that's sitting here. It's a triangle system. Triangle. When you see these triangles, and once again they make patterns, we would have taken a look at that and said, okay, this is something we may want to take a look at. Is it outperforming the sector? How's the financial sector doing? Yes, we should be in the market. How's the financial sector doing? Where should we, stock should we look at? Let's look at the matrix. Then if you own it, we're going to figure out, boom, we're going to pop through. We'd probably be buying here, but we're buying and holding longer term.
I have a question.
We're about time, and I'll keep going until everybody else comes in.
I use Fidelity and I do my own stuff. But if you look down at some of their analysis, you'll look down at the bottom at some of them, and some of the so-called experts, some will say buy, some will say hold, some will say, and I'm going, well, why are some saying buy and some saying hold?
Have you ever investment banking relationship? 80% of the stocks on the New York Stock Exchange that are covered by brokerage firms are on buy signals that they are telling you to buy.
Okay. I don't use
2% tell you to sell.
right?
The other ones are a hold position. Why are they telling you to buy? Where are they making money?
They want their money.
Investment banking. I'm not taking off the CEO telling him his stock stinks. Because they're bringing out a new initial public offering, or we're loaning them money, that's where we're making our money.
Politically.
The analysts are the worst. There was actually an analyst who just retired from Merrill Lynch and said he uses technical analysis.
QDEL.
What's that? Last one.
QDEL.
QDEL for Bill in the background.
Let's see if we